Hello, ladies and gentlemen. This is your host, Carl, and welcome to Empower Multimedia, where we help students in college maximize their time in college, and we help young adults learn about entrepreneurship so maybe one day they can be their own boss. Today's topic, we're going to be talking about funding and how you could potentially fund your own ventures. We're going to dive into 7 different ways you can fund your venture. So for those of you that want to start something big or even something that's not so big, but you don't think you have the time or money, here's some 7 different tips that you could potentially do that could help you out. Way number 1 is the most common way is bootstrapping. Now, some of you may ask, what is bootstrapping? Well, bootstrapping is the most common form of startup capital. The term bootstrapping is the use of your own funds, relatives' funds, or friends' funds to launch your own business. So this could be the money from your day job, your saving accounts, inheritance, or even reverse mortgages if you want to go that far. Now, while this is a great way to keep your debt low and you own your own business outright potentially, there is a risk if you do bootstrap and your startup fails that you would be in a really bad spot because you're investing a lot of money. And typically when people bootstrap, they invest more than they should in their own company and deplete their entire savings. So that's why bootstrapping can be the most high risk, high reward type of funding for a company, because one, you theoretically should keep as much percentage of your company as possible, or give it to the people that you love and cherish the most because they're helping you out if it's able to take off. So that's the reward portion of it. And the risk is, like I mentioned before, if it does fail, then you're in a really bad spot. But that's why I put bootstrapping as number 7 in this form, because I do think there are definitely better ways to create a startup, even if you don't have money, because the best way to create a startup is using other people's money. And that leads us to number 6. Now, something that a lot of you may not know is that there are actually a lot of competitions and contests specifically for startups. So these pitch competitions are very plentiful and they happen year round. And since I was in college, I know there's a lot, especially in Florida. For example, Florida Blue, which is more of a health-based competition. There's a Dabbler competition. There's a lot of different competitions where you can win a significant amount of money depending on the competition. They range from $1,000 to $5,000 to $25,000 to $100,000 if you just win. And the good thing about these competitions is, depending on which one they are, majority of them, you don't have to have anything concrete, just an idea. And as long as you basically sell the vision to people, you could potentially win. A prototype might be needed here and there on some of these competitions, but from what I've seen from my experiences, because I've been there, I either pitched or I watched other people pitch. As long as you have a really good presentation and you're able to sell the people on your story, your idea, your invention, then you have a solid chance of potentially earning some capital for your company to at least get a foundation started in your minimal viable product, which is an entrepreneurship term. Basically, that means a prototype per se. Now, the issues with these contests and competitions is obviously they're not frequent. They happen every so often. Even though they're year round, they're not plentiful. And the fact that it's only one winner typically, or 3 if you're lucky, it's going to be very difficult to actually win these competitions, as you may imagine. So that's number 6. That's contests and competitions. Now let's get to number 5. So the 5th way that you can fund a venture is through bank loans. Some people may know these as business loans. Now, banks that give out business loans, there's a lot of pros and cons of these. A pro is that a business loan will allow you to maintain complete ownership of your business. So that's a really good pro. Now, it's a better option for businesses that don't want to lose equity or really hyper expand. Business loans are typically good to just kind of start off and get the foundation and really work on building your system and make sure that you are perfecting your craft while you're in the incubation period of your company until you get to the accelerating period of your company. So typically, a secure way to get a business loan is you would have to go to your bank. I stress the bank because there are third lenders out there that typically have much higher interest loans, and those are what some people might want to call sharks. And banks typically have more, not, I wouldn't even say typically, they almost always have better loans or more preferred loans than these third-party investors. Now, when you go to the bank, you basically have to give up a lot of assets. And now, I don't know if I've heard some things in the past, and I'm not sure where it came from, where people think they could just get a loan without putting up any type of collateral. And for those of you that don't know, basically a collateral is something that you give to the bank in case you're not able to repay them back for the loan, and they can offset the loan by selling your assets. And 99.99% of the time, the collateral that's always going to be accepted is probably going to be your house. Because as you may know, the bank is not in the business of losing money. They're only in the business of making money. But the good thing about business loans is there are plenty of them out there, and many commercial banks offer small business loans and are fairly easy to apply to, because as long as you have a significant collateral, there's typically no reason that you wouldn't be able to get these loans. Be sure to offer a bank a detailed business plan, of course. Show them your expense sheets, your financial projections, and basically show them that you are serious about this and that you truly want to be successful in this. That's why you have everything planned out, and that you spent a lot of time making projections, doing a lot of market research, and that your projections are very meticulously thought out. And with that being said, as long as you have that you should be in a good spot to potentially get a business loan. But like I mentioned prior, do not be mistaken. The bank is in the business of making money, and you will almost 100% of the time not get a business loan unless you can either A, put up major collateral like a home, B, show some type of cash flow if you already started your business so they can see, okay, you actually have a business going on, and C, show them as well if you don't have a business going on, not only collateral, but that you actually have a plan in place that you will implement with the use of the money, and you can actually show them how potentially you'd be able to make them their money back. With that being said, that is part number 5. Now, the reason that this is part number 5 is because this actually involves debt, and I am not a big fan of debt. Even though there are debt that could help a lot of people, I try to stay away from that as much as possible, and I actually think there are much better ways to fund a business without using a business loan and getting yourself into debt. Which leads us into part number 4, investors. So some of you may be asking, well, what is an investor? An investor is basically someone that will take equity in your company, meaning they'll take a percent ownership of your company, and in return, they'll be able to exchange capital for that ownership percentage. So typically there's 2 types of investors. There are first angel investors, which are what I like to call early on investors. These are typically the investors when if you can't get a business loan or you don't want to get a business loan, you kind of used up all your bootstrapping money and you need more money to further the business. These are the investors you want to go to because they are typically single individuals that are able to invest anywhere from, I guess, $10,000 to $300,000. If you're lucky, you might find some angel investors that might be able to put up a little bit more than that, but typically they're on the lower end of funding. Now, some of you might think that $300,000, $500,000 is a lot of money, but if you're going really large scale ventures, that's really not a lot of money at all. Typically, people or companies seek out angel investors in the beginning of their venture, and they might need 1 or 2 angel investors, but eventually once you get a couple angel investors, you will have to move up in the funding and look for venture capitalists. So some of you may be wondering, what are venture capitalists? So venture capitalists are large entities that have a large sum of money that are bundled up from either investors, pension funds, 401ks, etc. And their venture capital basically gives 1% of their total fund to a particular startup. And when I say give money to a company, I mean a lot of money. Typically venture capital, they offer businesses anywhere from, $5 million to $100 million, maybe even more than that. That's how much money we're talking about. And what you need to take into consideration is that's still 1% of their entire portfolio. Now, the reason that they do this is because, as you may know in the startup world, basically only 1 out of 10 of the investments that people, whether it's angel investors or venture capital, that they put into pan out. And that's why they need to make sure that they get a significant discount rate and that their investment will replenish all their losses. So when you do get a venture capital, or I should say, if you do get a venture capital deal, they will work in hand with you. You're not going to be typically left alone because they want to see you succeed. So they'll be checking in here and there, and they typically want to invest into locations that are local to them because they always do want to pop up. Now, with that being said though, it is very, very difficult to be an early stage company and acquire venture capital. It's actually quite rare. But if you do happen to get venture capital funding, then you typically will be in a really great spot for at least a year to come. So this sums up venture capital as well as the investors portion. So pros and cons, like I mentioned before, is pros, you get significant amount of money, whether you go the angel investor or the venture capital route, whichever is best suited for you. But the cons, like I mentioned before, is in terms of equity, this is when you start parting away with your equity because they're not just going to give you money out of the goodness of their heart, unless I guess you are really lucky and run into somebody like that. But they're going to take a significant chunk of your equity in exchange for their capital. Now let's get to number 3. So the third best way to generate funding for your company is a kind of a new way. And thanks to the internet, this has been able to be an opportunity or a possibility. And that is crowdfunding. So what is crowdfunding? So crowdfunding is one of the newer ways of funding a startup that has been growing, or I should say gaining, a lot of popularity. So the way crowdfunding works is an entrepreneur will put up a detailed description of his or her business on a crowdfunding platform, and that can be from Indiegogo or Kickstarter. I'll link some of these in the link in the description. Now, the entrepreneur will mention some of the goals of the business, plans for making profit, and how much they need and for what particular reason. It's kind of like applying for a bank loan. Now, the consumers, which could be me, you, anybody else, these are literally everyday people, can read about what the business is doing and give them money if they like the idea. Those that are giving the business the money will make an online pledge with promises of pre-buying the product or giving a donation. Now, typically people may ask me, so what's the benefit of the consumer? There's typically a deal exchange of like the consumer would get a percentage of equity and when they crowdfund. Now, what the consumer doesn't typically know is that whenever they read these papers, they really don't read the fine print and probably are getting a significantly small amount of equity, which in turn makes it all worthwhile for the entrepreneur. And it's also a great marketing tactic. A lot of crowdfunding platforms have a lot of companies that invest a lot into marketing because there is a lot of instances or scenarios where people or social media picks up on what's new, what's trending, and companies blow up from it. You know, they go viral, and that gives them even more interest, even more traction, even more likely to get a loan, or even more likely to get startup capital from VCs. So it really is like a cycle effect if you do this right and do this really well. And also you can just get more money from people on the crowdfunding platform. So crowdfunding is definitely a great way to basically get startup funding for your future business. That is the pro of it. The con of it is you do give up some equity, but it's significantly less than angel investors and venture capital, as well as it's not guaranteed money. You literally are hoping that people believe in your company or your idea as much as you do. That's really the con of it, but the pros are massive. Now let's get to number 2. So some of you may be wondering, well, man, crowdfunding sounds amazing. What could be crowdfunding? Well, I'll tell you what could be crowdfunding. Number 2 is government grants. Some of you may be wondering, what government grants? Carl, does that exist? Yes, government grants exist. And to be quite honest, this may be one of the best kept secrets in all the startup capital acquisitions. Many people don't even bother looking up for government grants or small business grants because they think it's extremely difficult to get or impossible to get, which in some instances it could be difficult, but they're actually much easier to attain than people think they are. So in terms of government grants, they exist to help stimulate the economy and generate jobs that are not available currently. And they're a great way or a great source of income because, like the name itself, it's a grant. Grant is essentially free money that you don't have to pay back as long as you use it in the context that it's given to. You just can't use the grant for whatever you want. If you look through funding from federal governments, like for example, if you just go to the SBA, maybe SBDC, just look online and you'll be able to find what's out there. People are not going to tell you what's out there. You're going to have to look for what's out there. So in terms of grants from my research, commonly grants are offered to minorities, women, veterans, and entrepreneurs who want to start a small independent business. However, there are different types of grants available for all entrepreneurs, and I have a link to some of the grants from grants.gov that you might want to check out to see if you would be eligible for any of these. Now, you can also search for private small business grants as well. Search for FedEx Small Business Grant Contest, National Associations of Self-Employed Growth Grants, Idea Cafe, which are typically $1,000 business grants, and other things of that source. Getting a grant will be competitive. I'm not saying it's easy, even though I think it is easier than people anticipate. But if you are awarded a grant, in my personal opinion, I do think even though it could be extensive, doing your research and your due diligence and seeing what's out there for grants can definitely be worth your while in the long term if you are able to successfully gain the grant. So the pros and cons of the grant is, unlike everything I mentioned before, grants are basically free money. Now, you can't use it any way you want to, like I mentioned prior. There will be some terms on what you can use the money for, but it is money that you don't have to pay back. It's not debt. They're not taking a portion of your ownership. And it's really a great way to find funding. The cons would be that grants are not plentiful out there. There are some out there, but I wouldn't say there's a lot out there. But you have to do your due diligence, research, and just kind of see what's out there and really get into contact with who's ever making the decision of deploying who's the winner of the grant. Get good with them and see if the fortunes are in your favor. So that basically sums up the grants, and that is number 2. So now some of you may be asking, man, what could be number 1? Number 1 is product pre-sales. Product pre-sales are you sell your products before they even launch. Some of you may be wondering what's the difference between that and crowdfunding. And in my opinion, crowdfunding is people would potentially get a percentage of your company, and product pre-sales, they don't. Product pre-sales, in my opinion, are by far the best way to fund your company because it tells you 2 things. 1, you get funding for your company, and 2, it actually shows a validation or market validation that people actually want your product or service, and they're actually willing to pay upfront for your product or service before it's even out. But it's definitely a great way, and actually an overlooked and highly effective way to raise the money that you need to finance your business. Remember, your marketing campaign for this product pre-sale has to be fantastic. It has to grab the attention of the audience and make them really want to buy your product or service, or this operation will be null and void. This sums up the top 7 ways to get funding for your business. I hope this has helped you and has brought a lot of value for you. And if you think of anything else in terms of different ways to fund, leave it in the comments and discuss it with everybody else in the comments. With that being said, please remember, like, comment, and subscribe, and stay tuned until the next video. It's your host, Carl, and I'm signing out. Thank you.